All right. Looks like we've got almost all of our registered participants signed in now. So we'll get started. So what we're going to be doing is sort of walking through the full process of the first-time home buyer getting into the mortgage market. Just to introduce myself, my name's Darren Robinson. I've been a mortgage broker for 15 years now, and I do somewhat specialize in first-time home buyers. So it's a great market for me, and I've got lots of experience in it. You also notice too that I am a life insurance agent as well, and also help people out with life insurance and coverage for the mortgage after the mortgage closes. So that's it for me. Now, as far as this presentation goes, we're going to try to get it in within a half hour. I will be taking questions. You'll notice that there is a question and answer box that you can input questions in. So what I'll do is I'll try to tackle those at the end. Depending on how much time we have, we'll see what we can squeeze in there. But yeah, feel free to sort of put any questions in there that you have, and we'll hopefully get to those. And aside from that, contact information is right there. I'll have it at the end as well. It has my phone number, email. Those are probably the two best ways to reach me. And yeah, if you have any sort of direct questions and you want to sort of reach out more personal, you can do it through that. And I think that's it for the intro. And what we're going to do is jump right into this now. So, okay, here we go. So first thing is, why would you want to use a mortgage broker? Mortgage brokers work for you and not the lender or not the bank. So they're a third party representative that basically is able to sort of collect your information, figure out sort of what your scenario is, and then be able to then sort of figure out where the best fit for you and your scenario is with lenders. So if you go straight into a bank, then really you're focused just on their products. And generally there's only about 3 or 4 different products that they have to offer to you, where I've got dozens and dozens of lenders that I have access to and can make sure that we fit the right lender with you. So yeah, matching you with the best lender, which includes also the rates and features of the different mortgages out there. So obviously you want to get a great rate on a mortgage. And when you have choice with all kinds of lenders, then generally that is the way to do it. And also features. I mean, you want to make sure that you don't get sort of stuck in a mortgage that doesn't allow you to get out and or has a lot of very big fees in order to get out of as well. And also too, just being able to walk buyers through the entire process, right from the application side of things, all the way through to the lawyer's office. I'm part of the process all the way along and walk you through step by step. The other thing is I have great referral partners. If you're local to Barrie and area, I deal with a lot of real estate agents and lawyers in the area. And it's definitely a lot easier when you have direct access to those professionals and allows everyone to work as a team versus sort of independently. So it works out well that way. And then excellent communication. Basically, you want to be able to reach someone, a mortgage broker, in off hours, because you'll find that when you are out looking for houses, it's generally after hours or on weekends. And generally I can be reached outside of regular business hours and can help out when needed. So definitely a big plus there. And the best thing of all is mortgage broker services are free. It's basically there's a commission that's built into the lender. So when we close a mortgage with a lender, then there's a commission that comes directly to me. So there's no direct cost to being able to use a mortgage broker, which again is another big plus in the process. Now, things to start looking into with regards to getting into a house. Obviously, if you're coming from a rental situation or if you've been living at home with your parents, the cost of owning a home can definitely be sort of shocking in some cases. So there's a few different things that we want to look at in sort of how to manage a house. So the part of it is upfront costs. So the legal closing fees are part of that. So that's basically your lawyer's fees when you're going in and signing all the paperwork and registering the house under your name. That all costs some money, as well as land transfer fees. Now, being a first-time home buyer, you do get a rebate of up to $4,000 off of that. It all really comes down to the house price itself. So if the house price is above the threshold, then there is a portion that you would have to spend towards that. Sometimes there's property appraisals that are needed on a property. So where the lender just wants to confirm what the actual value of the property is. And then home inspection, that's generally a good idea. And real estate agents, I'm sure, will reinforce this, that you want to make sure that you have someone take a look at the house, make sure that there's no issues that might pop up down the road. It could be like a foundation crack or an issue with the roof or something like that. And sometimes they can be fairly major. So you definitely want to try to get a home inspection done on the property before you lock into the agreement. Also appliances. I mean, if you're buying either a reused or sort of resale house or a brand new house, I mean, appliances are generally something you're going to have to invest in, and they can really add up. I mean, you're looking at $5, $6, $7,000 if you want to get a full set of appliances for the house. Furniture and window coverings. If you get a bigger house, you're also going to have to fill it with furniture. And window coverings can be very expensive. I mean, they're anywhere from $20,000 to $50,000 for a house. So, I mean, those are definitely things that you need to sort of think about and budget when you're putting all your money together. And then just other little things like fence if you have kids or a dog, and then renovations down the road that maybe you want to finish the basement, and gain some extra room if it's a smaller house. So there's things like that you'd also want to consider. And then there's ongoing costs as well. So you've got property taxes, which is probably the largest ongoing cost that a house would have. And when you're looking at different houses, property taxes do vary from property to property. Generally, if you're in a city, the property taxes are going to be a little bit higher versus being outside the city in a rural setting. And also too, I mean, other factors come in there as well, like the waterfront can also increase the property tax, and different features like that will add up. So definitely something you should be looking at when you're looking at the various properties out there. Heat and hydro, that's another big one as well. Most people especially in a city, are going to have like natural gas. It's generally fairly cheap to run a house on natural gas, but then you do run into other properties that have like electric heat, or even just features on the house. Like there was a house that actually was a converted church that I had helped a client get years ago, and had a lot of glass in it, and it didn't have standardized heat. It was electric heat, and once they got through the first winter, they realized it was very, very expensive to heat. So again, it's something that should be in the back of your mind when you're looking at properties. And then, water, sewage, that's another cost that's ongoing. It's actually one of the areas that I've noticed that is sort of have the biggest increase over the last few years. So it's something, again, that you need to focus on and budget. And then there's other little things, just lawn care, snow removal, depends on the property and sort of, what you're able to do. A lot of people will do that themselves, but, maybe that's something you want to pay someone to do. And then just general maintenance in general. I mean, if you need to put a new coat of paint on or something like that, that's going to cost dollars over time. All right. And then for the next cost of home ownership, major repairs. Now, this is something that most people don't really sort of plan on, I guess. It's always great to have a rainy day budget that's set aside, but it's kind of easier to say that than to actually get it done. So there are big repairs like reshingling a roof. Generally, roof shingles last about 15 to 20 years, but then they have to be replaced, and you're looking at upwards of $8,000-$10,000 for a regular house. Furnace and air conditioner failures, again, fairly large items to replace as far as cost goes. So something that you should be aware of, and especially as they get older and older, then you do have to prepare for that type of thing. And then general appliance failures as well. I mean, there's other things like dishwashers and fridges and that sort of thing that, again, can be costly and can surprise someone. Repaving driveways, again, another big cost, and window replacement. Depending on the type of windows in the property, sometimes they do need to be replaced, after 10 or 15 years. So it's something that you should consider. Now, if you did fall short on money to be able to do something like this, there are options that we can discuss down the road, which are like refinancing, where you take equity out of the property, and it helps you be able to put money out to some of these larger ticket items. So anyways, so that covers off all of the costs. Now, as far as creating a home budget, now this is another sort of step towards getting a home, where you actually sit down and start writing things out on paper. Try to figure out, where you're spending money, and sort of what you're spending on now, what you can afford, and also figuring out those upfront costs that we just went through, and how you would be able to sort of handle that either on a month-to-month basis, or if something big did pop up along the way. And just also how your actual budget you would think would look like when you're an actual homeowner. So you can actually start putting some numbers in there with regards to heat, hydro, all that sort of stuff, and try to get an idea of sort of what you can handle month to month. Because one of the big things that I notice with first-time home buyers is that you might qualify for X number of dollars, but is that really the budget that you should be working towards? That's a question you really have to answer yourself once you start crunching these numbers. And then financing your home. So this is where I would basically step in. And one of the first steps in the mortgage process is getting what we call either pre-qualified or pre-approved. Now, there are two different types of things. Pre-qualified just means that you've gone through the application process and a broker has gone through all the details with you and make sure that everything's good, that there's no sort of red lights in there that would prevent you from purchasing a home. So that's the big first step that you want to get out of the way. The next one is the pre-approval side of things. Now, pre-approval is really, it's more of a rate hold than anything else. So you're just locking a rate in for up to 120 days, because the pre-qualified side of it kind of does all the major work as far as figuring everything out. And then the pre-approval is really just, making sure that you've got some certainty as far as what the rates are, especially if they start going up. If they go down, the pre-approval really doesn't mean too much in the longer run. And it does allow you to lock in a rate for up to 120 days. So it basically allows you to go out and start shopping for properties and gives you sort of that 4-month window to work in and have some certainty as far as the rate goes. And then other things here, I've got everything listed out here is the mortgage basics. Now, I won't go into too much detail here, but these are kind of the general terms of what we talk about when we're going through the details of a mortgage. The amortization period is just simply how long of a mortgage that you'll have, like the entire life of the mortgage. And generally with first-time home buyers, you're looking at about a 25-year mortgage. That's the max that's allowed at this point. And then you'd also look at your payment schedule. It can be anywhere from weekly, bi-weekly, bi-monthly, or monthly. And it all just depends on your preference there. I mean, the more accelerated you can make your payment, so the weekly and bi-weekly options, it actually does pay down your mortgage a little bit faster in the way that the interest payment works. So if you're able to do a weekly or bi-weekly payment, then it generally works out a little bit better and versus like a full monthly payment or something like that. And then as far as types of interest rates, I'm sure you've heard of the differences between fixed and variable rates. I mean, that's something that we go through and discuss. And I would say with first-time home buyers, you're generally looking for a fixed rate. We normally would do a fixed 5-year rate. And what that does is just gives you a little bit of budget certainty so that the rates don't start floating around, because that's what happens with a variable. It's a floating rate. And it gets adjusted as the bank rate changes. And there can be some pretty dramatic swings in those rates. And a lot of people have gone through that in the last probably 6, 7, 8 months with the interest rates going up on the variable side. So it's a tough thing to deal with when all of a sudden, your mortgage goes up $400 or $500 in the month. It's hard to find that extra money in your budget. And then mortgage terms. Now in Canada, generally terms are anywhere from 1 year to 5-year terms, and that locks the rate in for that period of time. And we do actually have longer terms as well. There goes 7 years, 10 years as well, but they don't tend to be as competitive a rate on the longer term. And I would say just on average, most people are looking at 5-year terms on mortgages. The other thing here is open and closed mortgages. So the majority of mortgages that you'd be dealing with would be a closed mortgage. And what that means is that there would be a penalty to get out of the mortgage. And that locks you in at a lower rate, basically. And you take on that risk of breaking the mortgage and paying a penalty, basically, to get out of it. But generally, most people won't really run into that. And then the open mortgage is the other option. And that's almost like a home equity line of credit, or something that allows you to pay the mortgage off in full and there'd be no penalty. And generally those are at higher rates than what a closed mortgage would be at. So generally people do tend to lean towards a closed mortgage in that case. The other thing here is conventional and high ratio mortgages. That's really just based off the amount of down payment that you have on a property. As a first-time home buyer, generally you're looking at probably less than a 20% down payment. But if you have more, then what happens is it converts into a conventional mortgage, and there's a little bit more flexibility with that type of mortgage. You're allowed to go to a 30-year mortgage, which stretches out the payments a little bit more, brings them down a little bit. But yeah, there are some other options that you can play with, but those are the two different types out there. And then there's prepayment options. Most lenders do have the option to prepay your mortgage up to a certain amount. And generally what amount you are able to pay down is anywhere from 10 to 20% on the mortgage per year. And it's great. I mean, if you have the extra money available and you can make those pay downs, then it really knocks down the interest over the life of the mortgage on the property. But again, I mean, life gets in the way, and it is difficult sometimes to try to keep up with, some extra money going out into the mortgage when you've got so many other sort of commitments outside of the mortgage. And then portability. Most mortgages are portable. What that means is it allows you to move the mortgage from your current property and then move it to another property. So say you decide that you're going to move in 2 to 3 years, you can take the mortgage with you. And if you've got 2 years left, basically take that 2 years to the new property. And what the lender will do is they'll have to requalify you, but you can also add money onto that. So if you're upgrading or adding $100,000 to your mortgage, you would then have to just requalify, and they would blend in the new money into the mortgage at today's rate. So it's a pretty flexible option, and it also gets around paying any sort of penalty to break a mortgage if you're moving. So it is something that people use quite often when they do move to another property. All right. Okay. And then continue on with financing your home. One of the other options that we've got with mortgages that's pretty handy with people that are out looking at properties, especially if they're kind of disappointed at some of the properties that they've seen, where they get into a property, they walk around the property and notice that like it's got carpet or old carpet or old windows or something like that, and that's not ideal, and they're kind of hoping for their dream home and it didn't quite work out. There is a program out there called Purchase Plus Improvements, and what that means is that if you say are qualified up to $500,000 purchase, if you decide that you're only going to spend $450,000 on a house, you can take that extra $50,000 and you can get or put that towards upgrades in the property. The lender would just require some quotes. So again, like I mentioned with carpet and windows, maybe there's a few windows that need to be replaced. You get a quote for that. And then you want to redo, the carpet, put hardwood in or something like that. You would be then allowed to allocate some of that money towards some upgrades that you'd be able to do right away. The only trick with that is that the lawyer does hold back those funds. So you do have to put up any deposit money or sort of money up front that's needed. But then after that, it's released to you, and basically you're able to get sort of paid back, and that those funds are worked into the mortgage. So it's a pretty flexible way of sort of financing some renovations without being out of pocket, basically, to do it. So yeah, it's something that we do on a regular basis. And they will allow up to generally about 10% of the purchase price. They'll allow you to add on in renovations. But anyways, I can go through the details with that if you had any specific questions outside of the presentation. And then as far as documents go, this is just sort of a really general list of what would be needed initially to like documents and information, to put an application in. So they're going to be looking at a 3-year employment history. And they want to know that there's been some consistency there, that they don't want to see someone that's really been hopping around, especially industry to industry, that, if you've been a carpenter and now you're working retail or something like that, they want to see that you have that consistent history of being in the same type of profession. They also want to know where you've been the last 3 years, so that's added in the application. We do have to confirm ID and confirm who you are. And then proof of income is generally fairly simple. You're looking for a pay stub, or most recent pay stub, and an employment letter directly from your employer that confirms what your income is. And also sometimes we can look at your T4 income if you've been in the same position for the last 2 years, if that helps sort of increase the amount that we can use with like overtime dollars or something like that that's added on to your regular income. And then proof of down payment. So again, want to be able to provide statements, and generally they're looking for about 3 months statements to show that you've got that money set aside and that it just didn't sort of appear in your bank account. And then proof of savings and investments, that sometimes if they're looking to see that you've got other assets, they'll ask to see some other statements there. And then current details of debts, which generally pops up once we run your credit history, and that generally is added right into the file. So you don't really need to get too deep into that side. Okay, and that takes us right into credit scores. So this is a really important part of, especially with first-time home buyers, of having established credit and being able to use that to help you leverage your way into a mortgage. So the first thing here is, what is a credit score? So it's a 3-digit number that represents your credit risk. And the number generally, it ranges between 300 and 900. And what you're looking for is really a score that's over 680 is kind of where you get into the good credit range. And that's really what you should be aiming towards is trying to get that built up at 680 or higher. And then scores are measured in a number of different facets here. There's payment history. So obviously, want to see that you've been able to make all your payments on time and over a longer period of time. The amount of credit used versus what's available. So they're looking at your credit utilization. So if you've got access to $10,000 in credit between maybe a couple of credit cards, and you're only using $2,000 a month in that credit, then it means that your utilization is low. So your score is actually going to go up. So that's a big plus. And then length of credit history. So the longer you've had your accounts open is also a big plus with regards to your score. So, like a new credit card or a new line of credit, something like that might not really help you that much if you've just, had it a few months, because there's really not a lot of history in payments and activity on it. So it does have to, generally they want to see like kind of 2 years of history there with any account. And then also the number of credit inquiries. So what they're trying to do is they're trying to weed out what they call credit seekers. So people that are going out there and they're trying to find credit wherever they can find it. And because they're basically sort of running out of resources and they need to find credit to survive. So they're trying to kind of weed those people out. But generally, if you're out shopping around for a mortgage and you have a number of sort of what they call hard hits on your credit that are specific to mortgages, then it really doesn't hurt you. It's really when you start looking for a bunch of different things. So it'd be like credit cards, lines of credit, maybe a car loan or something like that, and then looking at a mortgage. So that would be something that would probably drive your credit score down a bit. All right. And as far as continuing on with the credit score, yeah, I mean, important things is to check your credit score. Always make your minimum payments, because that's going to be one of the main driving factors in what your score is. And also too, by checking your credit, you're also going to make sure that there's no errors in your credit, because if you've got errors in there, they can take a while sometimes to fix. And if you're sort of in the process or already put an offer on a house or something like that, and all of a sudden that pops up, that becomes a real issue, and it could end up losing that house because of it. So it's always a good idea to keep up on that. And also be aware of identity theft. That's something that's really, really taken off in the last few years. And if you can make sure that you're keeping an eye on your credit so that there's not something that just pops up there that, has nothing to do with you. Because again, when that shows up, and you're actually, putting an offer on a house, that can take a long time to fix as well. So always a good idea to kind of keep an eye on it. And with Equifax, they've got, which is one of the two, there's Equifax and TransUnion are the two different credit companies in Canada. Equifax does provide you one free credit report per month. So you can check your credit that way, or there are other services like Credit Karma, and some of the banks also have services that they allow you access to as well. But again, I would look to see if you can access that on a regular basis. And then as far as building and improving your credit score, again, checking your report regularly is a good thing. Paying on time, keeping your utilization low, which we already spoke about. And then also limit applying for new accounts, because the multiple accounts will cause issues with your credit score. And also to keeping old accounts open, which is one that people kind of miss as far as what's important with your credit score, because when you do cancel a card that you've had for a number of years, you lose all that credit history, and you can actually see your credit score go down even though you're kind of cleaning up your credit. So keep that in mind when you're working with different accounts, that an older account can be very helpful to a credit score. And then mortgage loan insurance. Now, this comes into play when you've got less than a 20% down payment. And what you might have heard this called before is CMHC insurance. And it's called default insurance, basically. And it protects the lenders in the event that a borrower defaults on their payments. And it's actually the worst insurance that you could possibly pay for, because you're paying for it and it's actually just protecting the lender. It really doesn't protect you at all. But it's required by the government. So if you do have less than a 20% down payment, that loan insurance gets added on top of the mortgage, and you pay that off basically over the life of the mortgage. And it is a good thing in the long run, because what it does is it allows more people access to mortgages, and allows you to get into a house with just the 5% minimum down payment, which is nice. Yeah, and the premium ranges between 2.8% to 4%. So it all depends on how much your down payment of a down payment that you put together. That 5%, it's the full 4%, and then it goes to 10% down. I think it goes to 3.2% at that point, and then drops down to 2.8% if you have a 15% down payment. So yeah, I mean, if you do have a little bit larger down payment, it will save you a little bit of money in the mortgage loan insurance side of things. And the other thing to mention too is when you're budgeting for your down payment, also make sure that you have some additional money on top of the down payment for closing costs, because the lenders will have to make sure that you have 1.5% available on top of the down payment proceeds. And that just makes sure that you can cover like the things we talked about before, which is the land transfer taxes. It also covers the lawyer's fees, all that sort of stuff. So they're going to be looking to make sure that you've got that. So if you're buying a house that's say $500,000, you're looking at about $4,500 that you have to have in addition to your regular down payment available. And then as far as down payment incentives, now there are a few different programs that have come out, and this is the newest one. Actually, they just came out in the budget this year in January, and it's called the First Time Homebuyer Savings Account. And this is a really, really good account that is going to be very, very valuable to people. And it's just starting out, so anybody that's in the market right now might not be able to take advantage of it right away. But what it does is it allows you to put up to $8,000 per year into a savings account, specific savings account, and you get to write that money off each year like you would an RRSP. So say you made $40,000 that year, you put $8,000 into the savings account, you actually get to write your income down to $32,000. So there's significant tax savings by doing that. And then over a 5-year period, you do get to sort of add it up to that $40,000 in total that you can put in there. So it is a 5-year plan basically to get up to the maximum amount. And then the other thing is when you're taking the money out, it comes out tax-free. So very similar to a TFSA, that any money that you earn on it from interest and so forth is going to be tax-free. So that 40,000 might turn into 50,000 by the time you take it out down the road, and there's no income tax that's charged on that. All right, and it looks like we're kind of running a little bit behind here, so hopefully you can hang with me here just for a few more minutes. So the next type of down payment is Homebuyer's tax credit. So this is a tax credit that is on your income tax, that when you're filing your income tax, you can get up to a $10,000 non-refundable credit back, which could equal up to $1,500. So again, another nice little perk when you're buying your first time home. And then the other thing is there is another one called the First Time Homebuyers Incentive. This is an equity sharing program that I'm not a big fan of. It really doesn't come into play with houses in our area. As soon as you get over $500,000 on a purchase price, it counts you out of being able to apply for this. And it's also an equity sharing, meaning that the government actually owns a portion of your house. And I'm not a big fan of it, but it is out there and it is available. And then there's the RSP Homebuyers plan. And this is just the standard plan that's been around for quite a few years. And it just allows you to take money out of your RSPs as a loan, basically, that you have to pay it back slowly over time, but you don't get taxed on it when you take it out. So again, it's another handy way to get money for down payment. And then one other incentive as well, locally here in Simcoe County, and I know it's in other counties as well or other areas, is down payment assistance. And it's for low to moderate income renters in the area. And they will provide up to a 10% down payment, but you do have to qualify. And again, it's on the kind of lower end side. So again, if you're looking at houses that are over 500,000, it's going to be tough to qualify for this program. But again, it is a program that's out there. And then other qualifying assistance, and being first-time homebuyers, I do find that we do on a regular basis have to use a co-signer on a deal. And what that is either it's a direct relative or parent that is going to go on the mortgage with you and help you qualify just with their disposable income that they have. And they do have to be a strong applicant as well. Like they have to have good credit and good assets and also debt servicing. They need to be able to help out from the income standpoint. And then the other one that we're seeing a lot of lately is gifted down payments, that it's very difficult to put together money these days for down payment. So a direct family member can gift you a down payment as well to help you get to where you need to be. And then there is new government guidelines that they're looking at. One of the ones that I've heard of recently is for first-time homebuyers, they're possibly looking at extending amortizations to 30 years for that specific type of buyer, which again will bring down the payments and allow you to qualify for a little bit more. There's no real sort of news on that yet, but it's something that could come down the line later on. And as far as mortgage tools go, I do have an app that I'm able to provide. So if you want to reach out to me, I can give you the exact link to the Apple Store or the Android store and allow you to access that. It has some really good calculators on there, be able to drop some rates in there as well to try to figure out what your payments would look like. And then also my website's another big resource that has a lot of information on there, a lot of blog articles on different types of things. And it's just at darrenrobinson.ca. So feel free to check that out. And then questions. So looks like, let me see here. I do have a few questions. Let me just quickly answer a few of these here and then we can wrap things up. Okay, so the first one here is, does it matter where the property is? Yeah, from a broker standpoint, I'm licensed in Ontario, so anywhere in Ontario, I can help out with a mortgage, and now too with Zoom and with DocuSign, meaning like remote document signing. There's a lot of flexibility on that, so it really does allow us to sort of help out sort of anywhere in Ontario. The next one here is the qualifying process different if I'm self-employed. Yeah, that it does become a fair bit more difficult with self-employed because of the way that we measure income. And generally with self-employed, you try to write down your income as much as you can so you don't really pay a lot of income tax. And that can be difficult with first-time home buyers. So it would be something that we'd have to kind of really take a close look at to try to figure out your situation and what we can do. Okay, I got two more here. What if we start a new job and are on probation? So generally we're able to work with that as long as you're switching jobs within the same industry. So if you're like a nurse and you've been hired by a new hospital and you're on probation, you're in the first 3 months, generally we can use that income because it is technically, sort of almost the same job. So it's not that big of a deal that way. It's really if you're changing industries that becomes more of a problem. All right, and the last question I've got here is, can I apply for a mortgage while on mat leave? Yeah, you can actually. Mat leave, we are fairly flexible these days with that. Generally, as long as you can get an employment letter that has a fixed return date, we can use your full sort of guaranteed or regular income. So if you're just a straight full-time salaried employee, we can use that full salary to help qualify you. So yeah, that's actually a really good question. That is something that we can do now. So. And it might not have really worked out a few years back. They're getting a little more flexible with that. Okay, well, here, I'm not going to take too much more of your time. I've gone over my half hour. I try to rush through this. But yeah, if you have any other questions, again, my information's up here. You can either call me directly at 705-737-6161, or feel free to email me with any questions that you might have at darren@darrenrobinson.ca. And yeah, I'm happy to sort of listen to your scenario and give you some specific advice about your situation and try to figure things out for you. But anyways, have a great night. And I appreciate everyone showing up. We'll wrap it up now then. Thanks. Bye.